Today we learn about the financial ratios analysis, the financial diagnosis in the finance fundamental. What is financial ratios analysis? By definition, a ratios compare two financial figures to reveal a meaningful insight about the business. What is the formula? Ratios equal numerator by denominator. Both figures come from the income statement or balance sheet. What the purpose? Transform raw number into actionable insights for decision making. When and why use financial ratios? This is the key use case. In our internal management, in the credit analysis, in the investment decision, and in our benchmarking. The four major ratio categories. Financial ratios are grouped into four families, each diagnosing a different dimension of financial health: liquidity, profitability, activity efficiency, leverage, solvency. Each category answers a key question. For liquidity, can the company meet its short-term obligation? For profitability, is the company generating sufficient returns? For activities, are assets being used efficiently? For leverage, is the debt level sustainable long term? The liquidity ratios. Key formulas. Current ratios equal current asset by current ability. Must have to higher than 1.5. Quick ratios. Current assets minus inventories divided by current liabilities. Target must higher than 1.0. Cash ratios, cash divided by current liability. Target must higher than 0.5. This is a simple graph to show it. A ratio above 1 indicates the company can cover its short-term debt. Compare again industry benchmark for context. Profitability ratios. The key formula: the gross margin, revenue minus COGS by revenue multiplied by 100. Operating margin, operating income divided by revenue multiplied by 100. Net margin, net income divided by revenue multiplied by 100. ROE, net income divided by shareholder equity multiplied by 100. Rising margin over time signal improving efficiency and pricing power. ROI above 15% is generally considered strong. Activity and leverage ratios. The activity ratios asset efficiency from inventory turnover, receivable turnover, asset turnover. The leverage ratios financial risk from debt to equity, interest coverage, debt ratios. High leverage amplify return in good time but increase bankrupt risk in downturn. Always interpret leverage ratios alongside profitability. Theoretical example, step-by-step calculation. The company XYZ simplify financial data in dollar thousands. Current assets 150,000. Balance sheet. Current liability 100,000. From balance sheet. Net income 30,000 from income statement. Total revenue 200,000 from income statement. Shareholder equity 120,000 from balance sheet. This is your benchmark. Current ratios 1.5, net margin 15%, ROE 25%. Real world case Apple Inc. 2023. What the number tell us? Low current ratios, exceptional margins, and ROI of 147%. This is the expert tips. Getting the most from ratios. Always compared. Read the footnotes. Use a dashboard approach and track trend over time. That is for today and thank you everyone. See you soon.